All right, so I've been going over the Wyckoff trend study, and basically I've covered the uptrend from the start to the end. So what is left to be done here is really to sum up things, but from like more of a critical thinking type of way, and basically just put it in this little approach where the first thing is the situation, the second is the factors, and third are the issues or the points and questions. So just take whatever he's done and analyze it, but break it down like that. So, what are the situations? What are the factors that are eminent in the situation or are described by the situation? And then what are the issues in question? All right. So first thing is panic selling. That's the situation. Now, it is described by certain factors, two of which are spread and volume. Spread meaning range from high to low, and volume. And the issue is this public panic selling? Panic selling by the public. So it's the same thing, it's just, panic selling. The other thing to come up with is this the highest in the trend? Highest what? Highest volume. Most of the time, you will note that panic selling will have the highest volume in the trend. So it can be, and this is from both a bar perspective or a wave perspective. The volume will be extremely large and most likely the largest in the trend. And I want to qualify that a bit. Like over here, if it's a red bar, then you have to compare them to other red bars, not just red and green. Like it would be the highest red volume in the trend. So that's one way. What else do you notice? There should be multiple waves down. If it's panic selling, it progresses. It's a panic doesn't occur quickly. It occurs like the market is going lower and then lower and then lower and then lower and then bang, like that type of panic selling. It comes after a period of time. So I'll just consider it market at the end, and this is difficult to determine, but um, at the end of a rise or the end of a move, is the market is this occurring after multiple waves? It can also be bars when you're looking from perspective of a pullback, but I focus on this. So I don't like to use other waves, but I mean the idea is, let's say you have wave one and then three and then five, so it's like multiple waves. You know, panic selling will not occur on just a pullback. All right, unless that pullback is on a lower time frame, a bunch of waves down or up. So you have to put it in the context of multiple waves. That's what I'm trying to say. All right, so that would be for panic selling. And generally, you also want to see is price accelerating. Yeah, it's usually not all the time, but many times you see the speed uh, is straight down. The angle, the depth, the angle of the move is straight down. It's very acute. All right. So we're done with the panic selling piece. So the factors include spread, volume, position in trend. They also include speed. It's like the angle is typically usually acute. It's sharp. Anyway, so now the second piece I'm going to cover is the climax. How do you know a climax has passed? All right, and understand that when it has passed, at least in this case, the trend is up, tentatively up. How do you know? Well, the climax is panic selling, but who's panicking? It's the public. All right, so that's the first piece that needs to be there. The climax, then it should be met with professional buying. So two pieces need to be there to determine whether the climax has passed. Obviously, there has to be a climax. But the second piece is professional buying. So just keep this in mind. When professional buying meets panic selling, the climax has passed. So in behavior wise, it would be a climax followed by volume off the bottom or a change of behavior. Like heavy volume coming from the bottom. That heavy volume is professional buying at the best prices, the lowest, the steepest prices. They're getting a good deal. So climax plus volume off the bottom or change of behavior, what it means is public panic selling followed by professional buying. So what are the issues, points and questions? Well, first is professional buying coming in on a panic? Are they buying the panic? Is professional buying meeting the panic? That's the first thing. The second thing you want to understand is this short covering? So this point is whether that professional buying is temporary or lasting. That will depend on multiple factors. It could depend on the amount of volume that comes in, the but it's also very dependent on the secondary tests. So even though you have high volume on the way down and then high volume on the way up because of the climax and the bullish change of behavior, the question really is is this short covering, or is there lasting professional buying, meaning it's a temporary bounce, or is the trend going to turn and will there be a lasting move? So there are many different factors that you really won't know until the testing is complete, the base is built, and all of that. And supply has clearly been dried up. All right, now here is this temporary support or are they checking the panic? Meaning, is it temporary or lasting? Uh, is this all depends on are there low volume tests that hold? Meaning, what you're going to see is a climax, and then after that you'll see. I know some folks call it a automatic rally. The term Wyckoff used was technical rally, a customary after the panic or something like that. Those are his words. Like technical rally is what he called it. That occurs customarily after a panic or after a climax. So all that really means is you have a climax and you have a technical rally because of short covering or whatever. So when that technical rally occurs, you want to see the amount of selling that occurs on that technical rally to help you determine whether it's being sold. If the technical rally is sold heavily, it's highly likely that the move after the climax is temporary, meaning it's not going to be a lasting trend. They're just going to sell the rally. So you want to make sure you want to watch the technical rally, not just the test, but the technical rally to observe how it occurs. The technical rally will give you an indication. Is it going to be heavily sold? What is the quality and characteristic of the technical rally? Is it dull? Is it active? Does it have high volume? Does it show wide range spread? So on and so forth. The quality of the technical rally plus the secondary test is going to show you all whatever you need to know. So is the technical rally sold off? In the case where it's the bounce is temporary, the technical rally usually is heavily sold. That's the first chance to sell again at sell the bounce, and that's what they're going to do. Or is there a low volume test that holds, meaning the technical rally is strong and pulls back, and there's a low volume secondary test? Finally, the confirmation that he talks about is the secondary test, but he uses two confirmations. The first is confirmation, the second is final confirmation. Final, and meaning confirming the trend has changed. So confirmation comes in the form of a secondary test. He's looking for higher support, or has support been withdrawn and the panic selling is going to continue, or new selling is going to come in. So his idea of a confirmation is the climax has occurred, and now you have a automatic rally or whatever technical rally, and then it tests on low volume. The quality of the technical rally and the secondary tests, meaning the secondary test has low volume, is able to hold a higher support, will help you determine whether that climax has passed, confirming that the climax has passed. And the final confirmation that the climax has passed and there's a possible new trend up is a higher high. So the confirmation is a higher low on low volume, and the final confirmation is a higher high. This higher high, he's looking for it to take out the resistance area. Alright, so let's take a look at here on the chart. You're seeing a higher low. This is the climax, this is the higher low. This is the higher high. At that point, you can say, yeah, the climax has passed, and based on other indications, the trend has either tentatively or more lastingly turned up. So now what are the longs? What are long positions according to Wyckoff's study? There are three of them. One is buying with the CM. He buys with the CM. It's very obvious from his writings that he's looking for a climax and some type of change of behavior or volume off the bottom, which shows that professionals are buying at the best prices, and all he's doing is he's tailing them. He's ready to buy the low. I mean, some say don't catch a falling knife, but he's ready to do that when he sees clear evidence that buyers have stepped in heavily and aggressively and are buying. Wyckoff first long will be right after the heavy buying, which also occurs right after the climax. Basically, the question is there professional buying, the panic selling? If he determines there's professional buyers buying the panic selling, he's getting long. Second is on the springboard. The springboard is when the closes are clustered and there's low volume and there's a broad range of support. That all of these factors set up the springboard. Here you see on this chart, when you have a climax and you had that change of behavior, although it was intraday, you did have volume off the bottom that showed on the daily, and that pulled back, creating a broad range of support and a low volume pullback on the way down, and clustered closes where the net gain was very little on the last 1, 2, 3 days, showing what? That selling pressure has abated. Incidentally, this last bar where you have increasing volume and small spread, what many would call effort reward, or what Wyckoff would call abrupt volume, will help him make the decision to go long, either on that particular bar or the bar after. Okay, so right there is your springboard, and the next is the breakout. Wyckoff bought breakouts too, but he said they were the worst place to buy because you have a lot of risk. Where's the breakout? I think it's either this bar or this bar. I'm not sure, like which one makes the higher high, but the taking out of resistance, he's ready to go long. So the only problem is like the risk is a bit high, but he's ready to buy. All right, so those are the three long, um, the three long, the three opportunities to go long. Now, the next couple of things I'm going to discuss are the start of a pullback and the end of a pullback. The start of a pullback you watch by determining whether there is a lessening of demand, whether it's hard work to advance the market, whether buyers are reluctant to continue buying. All right, so he looks at this area here on this chart, and he's looking for a couple of things. One of which is clustered closes. Second is low volume. Third is shortening of the thrust. Fourth is abrupt volume, meaning supply is coming in. And fifth is a low end close. So you see on price, the factors of price, he's just looking at the low end and the high end closes, as well as clustered closes. He's also looking at from high bar to the prior bar, the high of the bar to the prior bar, to determine if there's a shortening of the thrust. From the perspective of volume, he's looking to see if volume is tapering off or shrinking or just mellow. And then he wants to look to see if there's abrupt volume. All of these factors together are helping him answer the question, are the longs having difficulty, and are they encountering resistance, or are they encountering resupply? Is there a minor climax? Does the abrupt volume come after the buyers are reluctant to buy, indicating that it's basically it's ending the move? Is there any sign of important distribution? Right. So the start of a pullback is looking at whether there's lessening of demand. This will be indicated by the volume. Hard work to advance the market. This will be indicated by the shortening of the thrust. Buyers are reluctant to buy. Again, this is basically volume. It also is the effect of that volume, meaning both the clustered closes and the progress in the closes. Next is the end of the pullback. Again, it's the same factors. What he's looking for is light selling pressure to end the pullback so the move continues up. He's taking a look at low volume pullback, climaxes, these are minor climaxes, high end closes, and clustered closes. It's really the same thing over and over again, whether you end this swing or that swing, whether it's upswing or downswing. It's basically clustered closes, shortening of the thrust, low volume, then abrupt volume. That's all there is. Then next thing that he discusses are prior tops with high volume and minor climaxes. I mean, this is just trapped volume. So where do you expect resistance or hesitation on the way up? Like, how do you know the resistance has a high likelihood of holding when you have trapped traders there? Why? Because not only will that resistance be sold off by new selling, because traders have a tendency to sell resistance, but existing trapped buyers will also sell. So you have two factors working in your favor, not just one. And the way you determine that is to see if they're trapped buyers. And here, For example, where the volume expanded, there are trapped buyers. So when price retested that top, it started having to go sideways, indicating two things. One, hesitation. Two, having to absorb that particular area in order to make a higher high. Okay, prior time, alright, did that already. Absorption, again, not going to go through it again, but some of its characteristics include low volumes of the dip, narrow ranges, narrow volume, higher lows, and hugging of resistance. Then he starts talking about distribution. What are some of the factors of distribution? Right here is preliminary distribution. As you can see, you have 1, 2, 3 days of high volume. On the third day, you have a lot of volume but lack of progress in the close. What is that? That is distribution. In this case, it was preliminary distribution. Another rally is coming. How do you know another rally is coming? Even after this preliminary distribution, it was not unable to break. Why? He gives reasons for that. Because some stocks get distributed, and the next stocks, industries get distributed, and the next sector gets distributed. So initial distribution occurred here. But how do you know that the market is going to continue to go up? And it's because of this bar with low volume, very low volume on that dip, is a bullish indication saying that there's a rally to come. And that's how you know another rally is coming. What about the ability to rally away from danger? When you see a threatening bar and it has no follow through, this is evidence that the market is able to rally away. So you want to be able to see threatening bars and determine whether they have follow through or not, showing that the market is not susceptible to a break. That's a bullish indication. Then he talks about expanded public following, and that expanded public following occurs when you have very high volume for multiple days at higher prices. When that occurs, it's the best time to unload inventory for the CM. Why? Because you have a broad and active market at high prices. It's very important to know this because this is the best place for distribution, at least preliminary distribution. When the market goes straight up, people buy without thinking and they buy at high prices. So this allows the CM to sell his position, or at least some of it, at these high prices. Distribution, again, distribution, no further upside progress or even staying in the range. So it's inability to make a higher high, inability for the closers to make progress, being stuck in a range on high volume is evidence of distribution. What are some of the other things you want to look at? Is there hypodermic behavior? Are there other early signs of distribution? And look for yourself to see, would smart money continue buying such high prices, especially if you're going straight up, or would he wait for the market to cool off and go to a support area before entering at such high prices? Now, the next behavior is change of behavior. All this is saying low volume pullback to high volume pullback. The behavior that is changing is low volume pullback to high volume pullback. That's the change of behavior. Places to short. The CM established shorts at multiple places. One of what Wyckoff does is he just wants to sell with the CM. So over here he sees that they're unloading on this climax, and they're unloading on the way up, and they're unloading on the way down. So he's going to sell also. Why? CM is selling. When he sees professional selling, he's going to just join. So it's not a matter of any particular type of structure like a behavior. It's more Wyckoff sold when he determined, bought and sold when he determined that the professionals were doing the same thing. All he's trying to do is tail them. So he's ready to buy low and sell high if the CM is buying there. That's the really key point. So that's one place to short. The other place to short, and I'll talk about that later. And then finally, the trend break Finally, the trend break here that you want to notice is the breakdown. What's different this breakdown, or even if it was a breakout than others? This breakdown is backed by distribution. There's a distribution and a change of behavior in the background. It's not a normal breakdown where you just have a range and two pivots and it's a break below the pivot or above the high pivot or whatever. This is backed by the CM establishing short positions. Then there's a breakdown. Similarly, this here is volume off the bottom, which is the CM establishing long positions, and then there's a breakout. So these breakouts have accumulation in the background. These breakdown have distribution in the background, where you know the CM has established short positions. In this case, you know the CM has established long positions. So these are, I consider them to be breakouts, but obviously there's a special background. That background, I think, is key in determining whether that breakouts and breakdowns are going to work or not. Instead of just structurally looking at, a pivot and seeing a bar, a big bar or whatever with a little bit more volume, that's totally that's much different than something like this. In this, where you have a climax, a change of behavior, a springboard, and then a breakout. And over here, where you have hypodermics, preliminary distribution in the background, a change of behavior, and then a breakdown. It's very different. Anyway, so I've covered the uptrend, the entire uptrend from here to down there. I've covered the springboard, the climaxes, the shorting of the thrust, clustered closes, high-end closes, short whatever absorption. So now what we're going to do is, not in this session, but further session, is start covering the downtrend. Alright, that's all folks. Thank you. Bye.